Hi, and welcome to CFI's Introduction to Corporate Finance. In this course, we'll cover a whole range of fundamental corporate finance concepts that will help you in any high-powered career in investment banking, equity research, corporate development, private equity, FP&A, and many more. This course is structured as a series of video lectures followed by interactive case studies where you can have a go. We've also sprinkled in tests and quizzes wherever possible for you to test your knowledge. This course is an optional prerequisite of CFI's FMVA certification program. And it's a valuable primer for those new to corporate finance, as well as an important refresher for those more advanced. We've got a lot of exciting information to cover, so let's get started.
For professionals who work in corporate finance, their ultimate goal is to maximize the value of a business through planning and implementing their resources, all while balancing risk and managing profitability for the company. The activities can be divided into three categories. The first is capital investments. This is where managers have to decide which projects to invest in and which businesses to acquire or to invest in. Their goal is to earn the highest possible risk-adjusted return on those capital investments. The second category is capital financing. With capital financing, the objective is to optimize capital structure, which means the firm will have the lowest weighted average cost of capital. And then finally, there are dividends and return of capital. This is when managers have to decide how and when to return capital to investors if they can't find a good enough use for it in the business. So in summary, managers in corporate finance are concerned with making capital investments that have high risk-adjusted returns, funding those investments with the lowest possible cost and best capital structure, and then finally returning capital to investors if they can't earn a high enough risk-adjusted return on it. In the coming lessons, you'll see how all these various components of corporate finance fit together as managers attempt to maximize the value of their businesses. There are two sides to the capital markets in corporate finance. On the one side are corporations, which represent operating companies. They're businesses in all sorts of different industries, and they need capital to grow and run their operations. On the other side of the capital markets, we have institutions that represent investors. These investors have money that they want to invest in companies. So capital flows from those investors into the corporations. And in exchange, corporations issue back to the institutional investors bonds or shares in their company. In the middle of all this sits the investment bank, and the investment bank, which is also sometimes referred to as the sell side, uses its relationships and its contacts on both sides to facilitate these transactions. So it speaks to the institutional investors and to the corporations and brokers the deal to raise capital and issue shares back to investors. And finally, in addition, we have the public accounting firms, which are involved in auditing and preparing financial statements for these corporations and are used by the institutional investors. So to summarize, we have four key players in corporate finance that we're going to be concerned with in this course. The first is the corporations. These are the companies that need capital. Two are the institutions. They represent the investors that have money. Three are the investment banks. They broker the transactions between corporations and institutions. And then finally, the fourth is the public accounting firms, which audit and oversee all of the financial information. So these are the key players in the primary market where new shares and new bonds are issued by corporations. Now let's look at the secondary market. In the secondary market, you have additional institutional investors or fund managers who want to buy securities of publicly traded companies. And you have some other fund managers who may want to sell their positions in those companies. This is where investors buy and sell on a stock exchange or over the counter using investment banks. And the investment banks have sales and trading departments as well as equity research departments that help facilitate all of these transactions between investors. This is called the secondary market because you'll notice that the corporation, the company that actually issued the shares, is not involved and does not appear anywhere on this page. These transactions are simply happening between investors. So investors are going to the investment banks to help them buy and sell shares in an already publicly traded company. Corporations are only involved in the primary market where they're actually issuing new securities such as new bonds or new shares. Let's take a closer look at the types of participants in capital markets. There are two main categories, as you recall from the primary market: investors and corporations. Within investors, we can further break them down into retail and institutional. Retail investors consist of high net worth individuals, and institutional investors can include mutual funds, pension funds, private equity firms, venture capital, and angel investors. So there are a wide range of institutional investors, and institutional investors may represent the retail or individual investors as well. Within corporations, there are, broadly speaking, just two types: public companies and private companies. Public companies are traded on a stock exchange, and private companies are privately held and traded by a few individual or institutional investors. Now let's take a look at the types of transactions that can occur between these various types of participants. The first is an initial public offering. This is the first time that a company issues securities to the public. Its IPO is its debut. Then there are follow-on equity offerings, where companies go back to the public markets to raise more money. Private placements are the name given to companies that raise money privately. Mergers and acquisitions are, as the name describes, when companies buy other businesses. Leverage buyouts are a form of acquisition where a company uses a lot of leverage to use the minimum amount of equity possible to buy another business. A divestiture is when a company sells a business. As we continue through the course, it's important that you're aware of these different types of participants and different types of transactions that occur in the capital markets.